Is QT dead? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Tony Greer, editor of the Morning Navigator newsletter, and Michael Howell, CEO of CrossBorder Capital. Hello to both of you.
Hi, Maggie.
Thank you so much for being here. It was a crazy weekend. We got off to start Monday. There were a lot of nerves, but things seem to be settling down a little bit. But I'd love to hear what both of you are thinking about the market. Tony, let's start with you and look at some of the sort of near term what we saw today. And it was an interesting day, wasn't it? We had regional bank stocks recouping some losses, the major U.S. indices up, although I have to look at where they settle because it has been a little bit whipping around a little bit. Bond yields stabilizing. What's your sense of the market action we saw today?
Well, the bond market volatility is still expanding, and we're still trying to figure out some of these historic moves on the tape. And I think that they're the most important moves. So I think we should, focus a little bit on them. We just saw the curve snap back from twos tens. I'm talking about from minus 110 basis points on March 8th to minus 40 basis points yesterday. We had Fed funds trade from from 5% on Friday to 4% on Monday. So these moves are absolutely massively historic. We saw a massive potential reversal in 2-year yields, right? We had the Powell testimony that ticked 2-year yields up to a new high for the move of 506. And then we had the Silicon Valley Bank blow up, ticked them all the way back down to a low of, I guess, below 4%. So we're trying to figure out what the bond market thinks of the world as it rapidly just changed from seeing a lot of inflation and a lot of rate hikes to a lot of deflation and no rate hikes and an economic slowdown. We're obviously dealing with an episode where the VIX trades into the 30s and the S&P backs off. What's been most interesting to me regarding the stock market, and today's leadership is an example of it. You look at the leadership today in this little bounce that we're seeing, and it's brokers and it's semiconductors, internet stocks, Qs, software, and social media. It's all technology. So technology has gotten back in the lead now that we've had this massive reduction in rate expectations and inflation expectations, right? We went from a couple of weeks ago where we had other sectors that were vying for leadership in the S&P with, metals and mining was up there, airlines were up there, and all of a sudden they've all been wiped out and tech has risen to the top here. So I'm kind of thinking that might be what leads us out of this Silicon Valley blow up dip, if you will. And I think that we may have seen the worst of it. It looks like a typical waterfall scenario that has sort of come and gone already, Maggie, if that's fair. It has all the earmarks, the VIX trades to the 30s and melts back. We saw 4 out of 5 consecutive negative days in the S&P. We just got our 4th day of massive tick extremes on the downside, which means there's indiscriminate selling going on. And the S&P fell 250 points, and that looks like that was the reaction. So I'm kind of playing it, more from the long side now, and still thinking that in the short term, and now I'm talking about through this week into next week, that I think we've seen the worst. So, I'm going to try to keep a handle on the bond market and, see what that brings if the rates really have turned, which it looks like the curve has turned and can start steepening. It looks like 2-year yields have turned and can start backing off. I just don't know if that matches with reality. Because as we saw today with inflation, even though it was bang in line, CPI is still 6%.
Yeah.
And we know that they're still, likely to see inflation higher for longer. So there's a battle royale going on in the bond market. And, trading is hectic, but, really good for short-term guys like me. And quite honestly, I'm dying to hear what Michael Belkin has to say.
Yeah, it's an interesting scenario. Tony, are you surprised when you see technology stocks? It seems like that market, that leadership is saying, okay, the Fed's backing off. But if the Fed's backing off, it's not because of good reasons. I mean, it's because we're in a situation where we're potentially going to see a recession. We had Moody's coming out, putting their outlook down for the entire U.S. banking sector, saying they see rapidly deteriorating operating environment. I mean, these don't sound like sort of good scenarios.
No, but the stock market is going to have some sort of celebration in that rate move, right? Fed funds going from 5% to 4%, 2-year yields from 5% to 4%. There's a lot of changes that take place in the portfolio when that happens. And if you look at how far, technology is off the highs and where it's just consolidated and sort of turned upward, all of these sectors were trying to break out before the Powell testimony and sort of got set back by the, volatility that we're seeing. And it's pulled them deeply back into their breakout zone. So if you look at what's cheap now, what's the cheapest sectors of the stock market are definitely going to be the names like social media and internet stocks that were down 40% last year, and they're just starting to bottom, technically speaking. So if that's where the money wants to flow, then that's where the money wants to flow. And I'm going to try to just catch on board there and not be judgmental, with the VIX at 25, and I'm just going to try to slap my singles here and keep moving.
Yeah, that makes sense. You follow what's going on, the market action's telling you. Since you're talking about following those flows, stay with us, Tony. I want to bring Michael into the conversation.
I'm
Michael, because
all
that's what you
ears.
do. That's what you do, right? That's you follow global liquidity.
Yeah.
So talk to me about what you're seeing. What are the flows telling you right now in the wake of, what we've seen in the banking crisis? And do you think that it's isolated and for the most part over?
I think the answer is for your last two questions, yes and yes. It probably is for the moment. I think this is a situation to draw a bad analogy, maybe. Is the patient sort of about to suffer a heart attack? No. There's chest pains. And I think the Federal Reserve is the paramedic that's coming in and supporting the system. Now, we look at global liquidity, we cover that, it's a highly quantitative exercise. We're covering about 90 financial systems worldwide to get a fix on global liquidity. We made the point late last year that we think the bottom in global liquidity is in. It was in last October. It's still very low. There's no question about that. SVB, Silicon Valley Bank, is a casualty of very low liquidity. You always get bank problems around the trough point. That almost signals that you're seeing a turn. The federal authorities will basically be wanting to keep an eye on this because there is a lot of fragility in areas of U.S. banking because, as we know, there's a long tail. It's not just the big money center banks that are important. There's a lot of smaller mid-sized banks that may well have funding problems, but the Fed is on top of it. I think one's assured by that. I think the key point is not necessarily SVB. The key point is what happened last September in the British gilt market. That was the real wake-up call to everybody. As Tony says, and I'm with him 100%, it's all about the fixed income markets. You've got to understand the fixed income markets more and more. That's not just looking at rates, that's looking at term premium. That's a wonkish concept. But look, the fact is that in the last 2 days, term premium on US 10-year treasuries have basically popped up 50 basis points. That is a whopping move. And that's basically saying it's reflecting the fact that investors are starting to take more risk. They want to take more risk in the markets. And that's, if you like, an upbeat signal.
Hmm.
The other thing we've got to look for is for the move index, bond volatility, to come down. Bond volatility is critical in creating liquidity or as a backstop for liquidity because collateral, we're in a funding system where collateral is all important. And so bond volatility is really one thing to watch. The federal authorities will want to see bond volatility down. In fact, monetary authorities everywhere will want to see things down. But to go back to the September of 22 point, why was that so significant? Because that was the time after the British gilt crisis that the Federal Reserve basically flatlined US bank reserves. They have not strayed away from 3 trillion US dollars ever since. For 25 weeks, they've been treading that threshold. And that's an important threshold.
So, Michael, I mean, but if bond volatility, getting that down is important, how are they going to do that? We just had Tony say we've seen extraordinary moves in bonds.
I think it's a difficult question, yeah, but I think we're at the peak. I mean, I would be surprised. What is the move? I don't know how it closed today, but yesterday it was 173.5. So this is a big number. The MOVE index is much more important than the VIX index these days, because as I say, it's so important for collateral, and collateral is really what drives the system, because liquidity comes from funding and collateral. So they've got to get it down. And I think what you're seeing is, if you like, maybe it's a philosophical move, but it's a move away from being lender of the last resort, which is what the federal authorities always used to be. That kind of ended in the GFC in 2008, and they basically became buyers of the last resort in the repo markets. So they were really entering into the money markets, and they were supporting them. I think what you've now seen is another iteration where they're basically becoming dedicated collateral managers. And what they're going to want to see is bond vol down and trying to control the sovereign debt markets. I mean, we can dance on the head of a pin and say, look, hey, the federal authorities want to control inflation. They want to keep employment up, or whatever it may be. At the end of the day, every central bank that's in business is controlling their sovereign bond market. That's what, if push comes to shove, that's what they do. Look at what the BOJ's been doing. Look at the Bank of England. It's switched with alacrity from QT to QE overnight. And this is what the Fed's done. I mean, these actions the Fed's doing is plain and simple QE.
So that answers our question for, are they going to formalize that and kill quantitative tightening, QT, somehow in this next meeting? So how do they approach this now, given the fact that they're constantly being pulled between this fight for inflation and fight for financial stability? It sounds like financial stability is the issue now. Do they announce they're not doing any more QT and still try to raise rates? How do you see it playing out?
Yeah, I think it's an interesting question, Maggie. I think, as they say in Ireland, if you want to travel to Dublin, don't start from here. And it's pretty much that problem. Now, one of the things that they'd done anyway is they'd changed the goalposts and shifted the goalposts on QT. Now, most people would have understood QT to mean liquidity withdrawal. But what the federal authorities were telling us is it doesn't mean liquidity withdrawal. What it means is getting treasuries off the balance sheet, okay? But that's not really what QT means. Most people would understand it's been a withdrawal of liquidity, but they've actually changed that definition. So it's quite possible they could still allow treasuries to roll off the balance sheet, so tick the box that they're really doing QT as they define it. But actually, the liquidity support that's going in is actually increasing. So it's not impossible to see them claiming to do a QT, but bank reserves, which is a measure of money in the money markets, could be going up. And that's really what liquidity is all about. That's what we've got to start focusing on. So they could actually have their cake and eat it here. They could claim to do one thing, but actually do something completely different and support liquidity. And liquidity is all important. Let's forget these cosmetic definitions of QT. It's all about putting liquidity in. And that's what QE is, plain and simple. And that's what they're doing.
So they need QE and QT at the same time.
Well, yeah. I mean, the bizarre thing, that's how they defined it. But, you look at this, the BTFP program. I mean, this could be big. This is, the bank funding, the term funding program that they put in. This could be significant. It could be, hundreds of billions, possibly.
I'm smiling because Michael had to make the point in your note that it is BTFP is not what people thought it was, which is buy the effing pivot rather, but it's actually the bank lending. It's funny that no one at the Fed realized, I guess, that acronym stood for something very different. Tony.
Might be, the answer to your question, right? The BTFP might be, the facility that allows bond volatility to back off, right? If we clear all these funding issues and everybody's plugged up overnight on an overnight basis, today we got the bond volatility index to settle just under 170. It's come off from the peak. Looks like it needs to trade into a range of like 120, 140 before the bond market's probably comfortable again. But it's usually those facilities, Maggie, that, make all the bears go away, at some level, all the bears that are attacking the credibility of all these institutions, and the Russells, the regional banks and the Russells have been halted and this and that. Those are all the things that hurt credibility. And the Fed comes back and says, okay, we're going to shore it all up. We've got another TARP program with a different moniker on it. Yeah. That's the end of it, right? That's the end of the liquidity problem in terms of SVB.
Which would explain, and this was my question to you, Tony, and Michael, I'd like to hear you on this too. The immediate response was, the Fed's credibility has been questioned anyway because of them being so late to fight inflation. They seem to have gotten it back with their aggressive action, but then everyone was asking, where were you on bank supervision? Why didn't you see what was happening to bank balance sheets as a result of your aggressive action? There seemed to be a lot of those questions over the weekend. Did the fact that they moved quickly and got this lending facility back up, do people feel like, yes, they trust that the authorities have it under control, Tony? Is that what we're seeing?
Yeah, there's a level of that, Maggie. There's definitely a level of, the Fed has come to the rescue, certainly at the point of sale where, the money would naturally be leaking out of. So that's where they've shored up the problem. If you look at how the bailout took place, it looks like, it was a very politically motivated thing. It could have been done in the private markets. And they chose not to. So that's even more of a reason why they're probably going to try to bottle this thing up as quickly as possible. And as long as that, as long as we don't continue to see stress on, the bond volatility index, on the VIX and things like that, it may take a couple of days. And obviously there's still a lot of portfolio changes that need to be made because of this change in the bond market. But still, it doesn't lead me to believe that we are looking for another waterfall leg from here.
Interesting. Michael, that there have I did an AMA with Mike Green today. I talked to Daniel yesterday, Lacalle on the daily briefing, and there is concern that this is the conditions that created the problem with Silicon Valley Bank and the regional banks is this aggressive move by the Fed, whether you want to call it what Daniel called it, which is the popping of the biggest bomb bubble that's ever existed, in the history of the world, or Mike, who kind of described it as, now we've got to pay attention to the level of rates. That was just the models that people looked at just weren't built on that. Is there some sort of they've managed the financial stability, but are we in a new regime now, do you think?
Yes, I mean we are without any question, but I think we've been in a new regime, pretty much since the GFC, or maybe even a tad before that. And the real issue is, dare I say it, the five-letter word China. I mean, China's the big issue, which has unsettled the entire financial system, and that is because when China joined the world economy back in 2001, came into the WTO, China imparted a huge deflationary shock to the world economy. Now, what happened is that central bankers mistook that for a monetary deflation, which spooked them in the 1930s. So they said, we don't want this, is dangerous stuff. So what we've got to do here is we've got to slash interest rates, put interest rates down at zero because we've got this monetary deflation. What we actually have was a cost deflation. Cost deflations are not that bad. You can live through those, okay? They're actually pretty, at the end of the day, probably pretty good things. But monetary deflations are bad, but it wasn't a monetary deflation. So what the federal authorities did was slash interest rates, if we remember, but that incentivizes debt. So what you saw was this huge piling up of debt over 20 years. And what we're now doing is sitting on a debt mountain. Now the whole problem here is that the financial markets have turned into not new capital raising mechanisms, but refinancing mechanisms. And in a refinancing world, polarity changes. Okay, and that's what the monetary authorities have got to remember. Now, the problem now is not interest rates so much. I mean, we'll come back to that later, but it's much more about funding and liquidity. And when you're using capital markets, which are your source of liquidity, as your weapon to axe inflation, you can't use them at the same time to refinance debt. And that's really the problem. And, you've got at the moment very flaky funding, a very flaky funding situation. And so the federal authorities have to keep coming in to kind of tape up the cracks. And that's what we're seeing again. And we're going to see it time and time again. So ultimately, what they've got to do is, in my view, they've got to ensure refinancing in the system, which means managing collateral, which means basically a three-letter acronym, yield curve control, YCC. It's going to come. And that's why I think Mike Green is saying it's all about controlling the level of interest rates. You can't have interest rates going up too high because that's going to damage your bond market. It's going to prevent collateral refinancing. There's a huge amount of debt which is upcoming, as we know, federal debt, the deficit blowing out. And if you look at CBO numbers, latest projections from the Congressional Budget Office, you're seeing the debt mountain swelling, but that's actually with a fairly benign prediction of defense spending. Now, what we know is defense spending is going to be a lot bigger than they're projecting right now, which is about 3% of GDP. It's going to be probably nearer 5. So the funding burden is getting even bigger. Someone's got to take that up and stop interest rates going up. Answer, Federal Reserve. QE is back, big time.
What does that mean for inflation?
Well, it doesn't necessarily mean anything per se, providing that money stays in the financial system, right? But what we know is that it can spill out. If it stays in the financial system, you get asset price inflation. So the thing to look at are, areas like stocks should do well in an environment of more liquidity. Commodities will do well. Things like gold, crypto do very well in that environment. So those are the assets that do well. Fixed income markets, apart from trading them, which we can do that through this year. But ultimately, if they're capping yields, they're not going to be that great.
Tony, we certainly know commodities, something you're always keeping an eye on. We saw move oil down. Looks like people are looking at the demand side of the equation now. And we have a question from a viewer as to whether you're back in Bitcoin. You want to give us an idea of how you're feeling about the commodity space here?
Yeah, sure. The physical commodity space is kind of bidless at the moment. We've got natural gas still trading around 250, which is kind of the middle of this bottom range where it finally stopped hemorrhaging. We just printed the low print of the year in WTI, which was the second lowest print of the move. We just settled on a 71 handle today, and the low of the move back in December was, just above 70. So a range break in WTI here would be, could be technically catastrophic. As you say, there's a lot of fear about the demand side now, fears about the, pending recession, blah, 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 that we've been dealing with for weeks now / months. I can't take my mind off of the supply side of the story because it still continues, to get tighter and tighter and tighter. You read the most recent stories are about, how we're coming to the end of shale growth and things like that, and how it's going to just take a lot more investment in the fossil fuel space to continue to get oil out of the ground and keep spare capacity where it is. So with that being the backdrop, I don't sense that there is a bottom falling out of crude oil, even if it does break the bottom of this range. I think it maybe drags lower. There's still, we've had a little bit of a flip where there's a little bit more gasoline demand than diesel demand right now. While the crack spread remains firm and the refiners are usually the ones that are on the bid for crude oil here, probably stemming the slide because gasoline demand is still firm. So the refiners are in buying WTI, cracking it into more gasoline than diesel now. And that has been the sort of supportive factor in the market. While the sort of, the deleterious factors are, worrying about recession, demand destruction, inventory growth. Inventories have certainly changed direction in the last, I would say, 3 to 5 weeks now, where they stopped depleting and started increasing again across the crude oil, gasoline, and diesel space. So that's why we're sitting back at the lows here in oil. We've seen already the bottom fall out of wheat. Wheat is now free, Maggie. I don't know if you saw the chart. But grains are offered, base metals are heavy on this side of the SVB blow up. And it's going to take a while before that gets turned around, like Michael said, until, I would say that it matters until, serious liquidity comes back. And it's going to matter, not until we get some kind of a risk on move where we get assets going on the upside, will we work off of this crude dip that we're on. So, I guess that's a little bit redundant, but it looks like they're going to be under pressure for a little while. I'm still a bull, but there's nothing I can do about the prices backing off. And if I look at some of the sectors, in the equity markets, no matter how I slice it, it still looks like the tech sector is a better buy right now than my natural resources sectors, which looks like they may back off from some of the highs of the moves. If you're talking about, XLE, XOP, sector, XME, which was just, running away with itself, has now backed off about 15% in 2 weeks. So we've seen all the natural resources trade back off into support. It looks to me like the risk is in tech leads the market to the upside here, and maybe financials recover quickly out of this abyss. I'm not sure, but that's how I'm looking at it right now, Maggie. And it's very much 1 day / 1 hour at a time.
Yeah, and that tech leadership certainly not what a lot of people thought when we started the year. Michael, this is an interesting question from John, and I think this is what gives people pause and makes them a little bit nervous about saying, this has been contained. What's the impact of accelerating move of bank deposits to money market funds? When I was talking to Mike earlier today, he's like the whole incident basically just was like a foghorn to every American saying, "Oh, by the way, if you have any money in the bank, you could be making a hell of a lot more of it sitting in short-term duration." Some people just weren't paying attention. You could get 5% if you were, or whatever, what 4% by going into a money market account. Do you think that that's an issue, that the deposit rates are so much lower than money market accounts, and that's a vulnerability for the financial sector?
Without question. I mean, it's a real risk, and I think Mike Green nailed that there. I think the point is that if there are problems in terms of loss of deposits, then you're going to have this new Fed acronym, the Bank Term Funding Program, actually acting more aggressively. And I think that the federal authorities have made a point. They're there to backstop the system, and they're doing it. And I think that relative to 2008, they've moved with alacrity. I mean, this happened over a weekend, and they basically, before the markets opened, they were there. So I think they understand the problem. And I think that what you've got is a situation where liquidity is going to start moving up. Now, I'd be less convinced that they want to cut rates quickly, that's for sure. But in my view, the big issue is liquidity. So I think the liquidity conditions are going to turn around. Now, when I was on my way for this call, I was reading the FOMC minutes from July of '84. Now, in May of '84, you may remember continental Illinois failed, and the federal authorities had been tightening. They were concerned about a rip-roaring economy. They were concerned about inflation taking off. And I'll read you the first couple of bits from what Paul Volcker said in the testimony, which you can go and look up on the Fed website. He says, "I think we're coming close to running out of maneuvering room." Okay. He said, "I conclude from everything we know that it's not time to take a strong initiative in the restraining direction." And basically, within a few days of that meeting, the Fed cut rates. So, that was the turning point. And he goes on to say, and actually, by the way, the other thing you can pour over in these minutes is they're looking very, very closely at wage settlements. And the conclusion they got to is it wasn't getting worse. In other words, wage settlements were beginning to reach a peak. And that gave them enough confidence that the economy wasn't the problem, the financial sector was, and the Fed came in to support it. And I think you've got the same now. Now, I think what you've also got to do is to start thinking internationally and say, well, okay, how does this pan out in Europe or in Japan or in China?
Yeah,
Now,
exactly. Let's go there. And by the way, it's amazing because people love to say history doesn't repeat itself; it rhymes. This time, it sounds, based on what you said, that it's repeating itself. So, talk to us about how this moves through the globe, and what is the liquidity picture telling you in different regions? Walk us through that a little bit.
okay, well, the most stubborn central bank has been the European Central Bank. They're slated, and I say slated, to reduce the size of their balance sheet by about 15 to 20% this year because of these support programs that were put in place during COVID are rolling off, and they're forcing them to roll off. So a 15 to 20% fall in the balance sheet in this context looks madness. So let's say that's not going to happen. They're going to have to come back in and find other programs to support the banks. And we know that if the US has got problems in banks, the European situation is parlous in that regard. It's a different dimension. So basically, they're going to have to change policy. Then you look at Japan. I think Japan anyway is basically operating a loose monetary policy. The incoming governor Ueda is likely maybe to change the target for the JGB, but at the end of the day, look, the JGB actually rallied on this, so maybe they don't have to, and they're basically pushing liquidity into the system. The Chinese central bank, the People's Bank of China, has just come off one of the most aggressive liquidity injections in their history. In 2 months, they injected 3 trillion yuan into money markets as the Chinese economy was restarting, which represents about 3.5 times what they put in the entire prior 2 years. So they're really going for it. Now, admittedly, February and March have been negative. They've taken money out, but I wouldn't expect that to last. They're going to be putting money back again, in my view. So I think you've got a lot of these central banks started moving now towards the easing side. And as we say, the low was in last October for global liquidity, but it's pushing up. Doesn't mean to say bad things won't happen at the trough. They will. Better to have more liquidity than less, but I think the direction is moving upwards. So I go with what Tony's saying, is that this market probably is in a trading range and you've got to trade it. And I think the fixed income markets, in my view, are in a trading range too, until they break out. But I think the breakout will be on the upside, maybe in 6-9 months' time.
It's so interesting to hear you say that because it feels so fraught now. I think when we saw that failure and the feds have to come in, it just seemed like it was such a dangerous period. But it seems like what you're saying from what you're seeing on the liquidity flows, that the worst is in, and that it's going to be a much more productive period for risk assets in 6 months. Am I hearing you right on that?
Yeah, I mean, never say never, of course, but we could be spooked by something in the next 2 or 3 days. Who knows? But at the end of the day, I think you've demonstrated you've got Fed support. The Fed's in there, and as I say, this program they've announced, the term funding program for banks. I mean, that could be it's very generous. It could be significant in size. I mean, on the back of the envelope, it could be 100, 200 billion. I mean, it could be a lot of money going in to support these banks. Maybe at least that number. So you've got impetus there. And I think if you go back to the 1984 continental Illinois failure, I mean, that did signal a turn in Federal Reserve policy. And you basically saw that was the run up. Markets basically began to pick up quite significantly, as we know, through 85, 86, and into 87.
So if we're in a trading range for some markets, are we in a range for Fed rates? So just because they are doing these facilities and they may not be hiking anymore, can they leave rates where they are? Or are they just too high for this sort of situation we're in?
Well, I think if you go back to the transcript from 84, what Volcker said then is that it was inappropriate to tighten at that time in the wake of continental Illinois. But he said, we're not going to rule out a later tightening if the need arises. Actually, it didn't arise until actually sometime quite a lot later. So in other words, rates then were cut for many months in the US. The policy was eased. I think in the current situation, my view would be that the Federal Reserve probably stays pat where we are now. I mean, it's possible, conceivable they can put a small rate increase in, but I think they're more likely to stay where they are, sit on their hands for a while, watch what happens, not rule out another rate increase. But I think at the end of the day, I keep coming back to this sort of philosophy which says that what central bankers have got to learn is what is called the Bagehot rule. Bagehot was a sort of the doyen of central bankers. He was a British journalist in the financial journalist in the 19th century. He wrote all about financial crises, and Britain had its fair share. Jim Grant in the US has written a fantastic biography of Walter Bagehot. But Bagehot's rule is you lend freely, i.e. lots of liquidity, at a high rate of interest against good collateral. And the problem is most of our bankers, our central bankers, have been doing the absolute reverse for the last 20 years. They've got to start learning this. You need lots of liquidity, but you have rates high.
Yeah, which is going to be a completely different place to be. Are any signs? We're already out of time, but I got to stretch it because you two amazing guys, and we're in these precarious times that people are really worried about. Any signs of collateral scarcity that have created problems before, Michael?
Well, we are in a world where collateral is short. That's for sure. That's the ultimate problem. I'd say the positive in the next 2 or 3 years is that once the debt ceiling issue is resolved, and bear in mind that's another problem which is going to make this whole thing complicated. But looking through the other side of the debt ceiling issue, there'll be a lot of coupon issuance coming, which is basically great collateral. And you've got two areas of good collateral in the world: U.S. Treasuries and German bonds, and we basically need more of those. And that will help resolve the problem. But there is a shortage. That's what the fixed income markets have been telling us for the last 2 years.
And then last question to both of you, Tony. I'll ask you first. Just I'm absorbing everything Michael just said. Do we feel like with this now and the Fed very focused on financial stability, probably going to back off any aggressive rate hikes? What are we thinking about the economy? I mean, do you think the market will start to move away from the idea that we're going to see a very severe, deep recession if it looks like the Fed has a handle on this?
I don't know that necessarily one is going to mean the other, Maggie, where if they recognize that the Fed is easing in reaction to Silicon Valley Bank, will that mean that we necessarily may not, it may lower the odds of a recession. It may,
Mhm.
maybe soften the stance on it a little bit, but I think that that's been programmed in by higher interest rates, right? I mean, that's what the
Right.
Fed is trying to do to slow inflation down, was really kneecap the economy, and now part of it's being done for them. So
Mm.
I don't know, and then once again, I'm not an economist, so I don't really.
Yeah, it's that lag. It's hard to know when everything. Michael, what's your thought on that? Are we still, is this sort of recession already baked in, or do these current events maybe mean that they back off before they push it really into a deep hole?
Well, I suppose I start from the perspective. I think we've had a lot of the recession already.
Hmm.
I think that's my starting point. I've never really been of the view that there's a deep recession. I think the fixed income markets are telling us that anyway. I mean, looking through this crisis, that there was likely a turning point around mid-year anyway for the economy. It was likely to get better in the second half, and that's what I think the message from the fixed income markets was. I don't believe the yield curve. I think the yield curve is a highly distorted indicator anyway, but it's particularly distorted right at the moment because term premium are so negative, which comes back to the collateral shortage issue. That's what's biasing it. So I don't think there's a deep recession. I think the economy is slowing, but the best heads up for the economy is to look at the performance of cyclicals versus defensives. That's always been a much, much better predictor than economists of what the economy does. And that was the old Stan Druckenmiller rule. Look at the internals of the market. It's the best economist. It's right again. So look at that. I think that's one thing. And I think the other thing, which is, again, I stress not a recommendation here, but if you want to know what the liquidity situation is at any moment, look at Bitcoin. Bitcoin goes up, there's a lot of liquidity in the system. If it goes down, you've got a shortage. It's not a recommendation for crypto, but it's just an honest assessment that these things are liquidity barometers.
Yeah, fantastic point,
I
Michael.
gotta
As
say,
we
Maggie,
go ahead.
I wanted to reach out and hug Michael right there when he said that he already saw the recession, because I feel like we've been through this already, right? We saw two negative quarters of GDP. We watched the yield curve collapse. We saw all the effects of the recession. I feel like the market saw the recession, and it was only because we created this argument while it was happening, whether or not two negative quarters of GDP actually meant recession, that all of a sudden the economists got their books back out and said, okay, let's go looking for the recession again. I mean, the market saw the recession, whether or not there's one coming or not, or you know what I mean? So I think that that's what we're reacting to. And so it makes me feel better about my view, hearing Michael describe that sort of from a different angle. That was really comforting for me.
Yeah, I think the labor market threw people on that argument too, though, right? A lot of people were thinking we couldn't have been in recession if we had such a tight labor market, and people kind of scratching their heads about that as well.
Totally
Uh,
fair.
is the labor are the labor should we not pay much attention to those labor figures, you think, Michael, when we're looking at that?
Yeah, but I think the labor market's distorted by a number of things. I mean, one is visa controls have had a big effect in the
Mhm.
US. You've got the other thing, which is COVID. I mean, COVID has basically decimated a lot of the workforce. People have taken early retirement. It's a very, very misleading indicator. And I think I mean, you I don't know if you went through this with Mike Green. I know he's got some strong views about how distorted the employment data is. But you listen to
Yeah,
him, and you
we're
wouldn't
yeah,
you wouldn't say
we'll have to we'll have to dive back into that again. We're all sort of focused on making sense of what is complicated for a lot of people with this banking situation. So we didn't get into the labor conversation. And that AMA with Mike Green is on the platform, everyone, for you to check out because we did cover a lot of good stuff. As we close, Michael, anything that you're worried about? Is there a risk out there that concerns you? Because it sounds like that liquidity is turning up, things are going to look good in 6 months, the recession's past us, and that federal regulators sort of have a handle on what's going on. Is there anything that does concern you in this scenario?
I think one of the issues we've got is the uncertainty of the debt ceiling. That's not helpful. And we don't know if there are skeletons in the closet that this crisis brings out. But I think generally I'm more positive than negative right now. There's always something that's going to surprise you. But generally, I mean, the other thing I suppose to throw in is that the Europeans are not always rational when it comes to reacting in these situations. I mean, after all, they were the ones that tightened during the GFC, initially at least. So there may be something foolish coming out of there, but at the end of the day, as I say, I'm more upbeat than not.
Fantastic. Michael and Tony, thank you so much for your time. It was so great to have the both of you on. I think it was a really sort of fresh perspective and one that we haven't heard. So helpful for everyone. We appreciate the both of you.
Thank both of you. That was helpful for me.
Yeah.
That's all we can do is all help each other,
Thanks.
right? We are, and we're going longer with these. Michael, we got to get you back for an extended Friday. Everyone's asking on the chat. But we are going a little bit longer because it's an important time to try to provide everybody with some information and some tools so that they can sort of get through this. I'm going to be back tomorrow, same time, everyone, with 𝗗𝗗𝗬𝗦. That should be really interesting in terms of market positioning. So please join us then. Thanks to both of you, everyone out there. Take care and good luck.